Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Now we are solving income tax, incidence of tax previous year question paper question 2025 Jan Feb we are going to solve. See, this is most important and easiest. You can score the marks. 12 marks easily you can score. Only thing is you need to understand where it is taxable and where it is not taxable. That's it. Incidence of tax. Mr. Barani furnishes the following particulars of his income from the previous year 2023-24. Interest on German development bonds rupees 60,000, 2 by 5th received in India. Income from agriculture in California received these but later on rupees 50,000 remitted to India 2,80,000. Income from a property in Sri Lanka received there rupees 80,000 spent in Sri Lanka and the balance remitted to India rupees 2,20,000. Share of income from partnership firm rupees 20,000. Dividend paid by an Indian company received in Canada 56,000. Past untaxed foreign income brought to India rupees 1,05,000. Profit from business in Mysore but controlled by London rupees 72,000. Profit on sale of building in Mangalore but received in Dubai rupees 1,18,000. Pension from Indian company received in London rupees 36,000. A gift cash received from a relative in India rupees 60,000. Interest on fixed deposit from Canara Bank rupees 12,000. Calculate the gross total income for the assessment year 2024-25 if Mr. Barani is a resident and ordinarily resident, a resident and not ordinarily resident, and a non resident. Let us calculate this. See here, this is the format for the computation of the gross total income of Mr. Barani when he is resident and ordinarily resident, when not ordinarily resident, non resident. Now, what is the first transaction? The first transaction is interest on German development bonds, 60,000. Here, 2/5 is received in India. Now, whatever you have received in India, it is taxable to all the three. The first one is interest on German development bonds. For resident and ordinary resident, the whole amount is taxable. All this 60,000 you need to record. 60,000. For not ordinarily resident and non-resident, whatever the amount which is received in India, that is 2 by 5th. 60,000 into 2 divided by 5. 24,000 is taxable. 24,000. 24,000. Then, next transaction is income from agriculture in California. See, this is not an Indian income, but you have done agriculture in the California. Received this, but later on rupees 50,000 remitted to India, rupees 2,80,000. Here you need to understand it is taxable only to the resident and ordinarily resident, not for the not ordinary resident and non-resident. Okay, income from agriculture in California. What is the amount? Whole 2,80,000 is taxable to resident and ordinarily resident, because he is an Indian resident and ordinarily resident who visits and who become not ordinarily resident, who is not at all stays in India. It is called as non-resident. Okay. The next one is income from property in Sri Lanka received there 80,000 spent in Sri Lanka and the balance remitted to India. What is the amount it is given? 2,20,000. This is also your property where it is in Sri Lanka, not an Indian income. So only for the first one, for C, income from property in Sri Lanka. You have received there only. So only for him it is taxable. 2,20,000. Other two it is not taxable. Then next one, D. The next transaction is share of income from partnership firm. Share of income from partnership firm is a exempted income. Share of income from partnership firm. It is exempted income for all the three. Exempted income. The next is, what is next transaction? Dividend paid by an Indian company received in Canada. What is where it is situated in India and paid where it is in India. So it is taxable for all the three. Okay. E. Dividend paid by Indian company. 56,000. Taxable for all the three. The next one is past untaxed foreign income brought to India 1,05,000. This is also exempted amount. Past untaxed amount. What is the amount? 1,05,000 is exempted income. Here you need to write exempted income. Exempted income. Okay. The next, profit from business in Mysore but controlled by London, 72,000. So where is the work is taking place? In India. So profit managed in India. Business in Mysore. It is taxable for all the three. That is 72,000. 72,000. The next one is profit on sale of building in Mangalore but received in Dubai. Where the profit you received in India, where the property is situated in Mangalore. It is in India only. So only it is taxable for all the three. Profit on sale of building. 1,18,000. 1,18,000. 1,18,000. What is the next transaction? Next transaction is pension from Indian company received in London. Paid from where? India. So it is taxable for all the three. Pension from Indian company. You have to see from where the income is generated. That is most important. 36,000. 36,000. The next one is a gift in cash received from a relative in India, rupees 60,000. So whole amount is taxable. Okay. Gift in cash 60,000 taxable for all the three. Then last is interest on fixed deposit from Canara Bank. Interest on fixed deposit is taxable. Interest on fixed deposit 12,000. 12,000. 12,000. Now let us do the total. Total is 60,000, 2,80,000, 2,20,000, then 56,000, 72,000, 1,18,000, 36,000, 60 plus 12, 9,14,000 for resident and ordinarily resident. For not ordinarily resident is 24,000, 56,000, 72,000, 1,18,000, 36,000, 60, 12,000, 3,78,000. For non-resident 24,000, 56,000, 72,000, 1,18,000, 36,000, 60,000, 12,000, 3,78,000. See, this is most easiest chapter and you can score the mark easily. Only thing is you need to understand controlled, managed in India and income which is derived in India. That all you need to observe. And which are the exempted amount, which are all not exempted amount, which are partially taxable. That you need to understand. Only that much. And that comes when you are practicing. So practice more, you will be perfect. Thank you for watching. Have a great day.